Markets are moving way different than they did at the beginning of the year. What has changed and what is working today? Hi, I'm Doc Severson with ReadySetTrade. Welcome to today's Market Minute for Monday, the 30th of May. Let's start by talking about market character, because unless we understand market character, we won't understand anything else that's happening in the market today. Now, what I've got here is a chart of the S&P 500 from about the last 2 years or so. So you can see from this, the 2019 rally gave way to the pandemic crash, which was good for about 35% to the downside. Now, to me, this is not a bear market because it was so quick. It dropped 35% and then almost immediately got back up within a couple of months or so, right back up to the highs. Now, the character that we saw starting around the summertime of 2020 is what we call quiet and trending. So this is where we have rallies to pullbacks, and along the way, and the further it got, the more linear and the more predictable that it was. This, again, is a great example of what we call quiet and trending behavior. This is where retail traders feel the most comfortable. This is where the pullbacks are generally gentle and predictable, and they almost always produce a rally to the upside until they don't anymore. And this is where we get into the character change into sideways and volatile. Sideways and volatile is what happened on the initial correction here as we got into 2022. We had a transition from quiet and trending into sideways and volatile. Now, as we got into early April, everything was still okay. Sideways to volatile is always the transition character that a quiet and trending bull market moves into. And sometimes what happens is it goes from that sideways and volatile back into quiet and trending. I can give you examples such as 2011, 2012 to look at, and all of those reclaim the upside trend. But in April, mid-April or so, something nasty happened. What happened was we got our first lower high. And this is where we transitioned from sideways and volatile into trending and volatile. And this is also code word for bear market behavior. So to me, this is the first leg of a bear market. This one has taken about 5 months or so, so this is a little bit short. A true bear market is typically about 18 months long. So what we may see next is a grinding rally back up. And let's go out to the weekly chart so we have a little bit more space to work with. So a grinding rally back up that gets back into this area. And then what happens from here is one of two things. Obviously, we either get a blast off back up into quiet and trending, or the second leg of the bear market starts. And this is where the worst of the selling is. So I'm not here to push one narrative over the other. All we care about right now is that this is quiet and trending, and this is trending and volatile right now. And because of that, we have very different price action than what we had in 2021. And the strategies that we have to pick have to reflect what's happening with the price. Okay, so that's point number one. The market character has changed. Now, if you just can't look at this chart and tell that there's a difference in the volatility between where the pullbacks are and how the price moves on a day-to-day basis versus what we're seeing here, then maybe you need some different tools to look at this. And so one of the first tools that I can do with this is to go to what's called the ATR, or average true range. And so what I'll do is I'll go to that with the S&P 500. And what we want to look for, the average true range is going to be measured down here. So we can see that for the pandemic move, that was an average true range of about 152 points, which is a record. If we compare that versus what we saw back here during the great financial crisis, that was only about 62 or 63 points a day. So a huge change. And this is a lot to do with the quantitative easing and the fact that the price is now, 4,000 points plus instead of 1,000 points from 14 years ago. So we can use the ATR, the average true range, to understand the character of the market. We're going to see very low values during quiet and trending periods in the price action. And then we're going to start to see it increase as markets go into this transition into sideways and volatile. And then if we're going to move into trending and volatile, it's going to get even larger. So this was a very short period of trending and volatile to the downside, which almost immediately got changed right back to quiet and trending. This is one of those rare unicorn corrective moves that we have where it's over with so fast, it's almost like ripping the Band-Aid off. So now we have a very elevated value of average true range, and this is the second largest value ever recorded on the S&P 500. And if that's not enough, if you're uncomfortable with picking up direction from the chart, maybe you can use the option chain to pick up a statistical value from this. And what we're seeing in today's world is the expected move is running about anywhere from high 30s up to about 55 points per day on the day of. So in other words, if I'm looking at a 0-day option, so tomorrow this will be the 31st of May, and if I see this up there in the high 30s to 40s, which right now it is 46, tomorrow it'll be slightly less than that. But this compares to last summer where we had expected moves of maybe plus minus 12 points, 15 points, things like that. So the expected move is another way that we can look at this. And of course, also the implied volatility for that particular day is another data point that we can read. Now let's move away from market character and let's start talking about strategies that work and strategies that don't work anymore right now. So back in 2021, we were using option selling strategies like the Iron Condor or just about any other selling strategy that you want to use, such as like long calendars or any other short gamma type of arrangement where you're net selling an option for income. And this is a really easy period of option selling because the corrective moves were so mild and so short that for most of the time, even though there was a very persistent trend here, it was a very manageable trend. It was very easy to sell options to be able to get in, get your fair share, and get out. Now what's happening is trades that were entered here at lower volatilities are getting run over to the downside. And then as you adjust those strategies and maybe roll down your calls like you've been told to do, you get run over on the bounce back up. And we're seeing that happen just in the last few days once again. So right now, selling strategies are very difficult unless you're going to be selling to the downside. So in other words, selling cash secured puts into, just these horrible days where the implied volatility spikes. It feels like the worst thing to do, but some of these trades can be really, really good if you find levels that you're a willing buyer at. So for the right type of people, the right type of accounts, you can do that. But as a general rule, that's not really what's working today. So what is working today? Well, what is working today is now that we have 5 days a week of 0 DTE options. So we can see this. We have options for Tuesday, Wednesday, Thursday, Friday. Then next week, Monday, Tuesday, Wednesday, Thursday, Friday. Then the following week, 5 days a week now. So this has been like this now for a couple of weeks where we've now finally, after all this time, have 5 days a week of options that expire that day. So we get these great 0 DTE options. Since these options expire every day, let's move to an intraday chart since our battle really exists within the span of one trading day. And let's talk about another couple of points of terminology. One is the upper and lower expected moves. So every day, based on the opening bell print, we're going to have a plus and minus expected move. This is the one standard deviation reading into where the price could close In other words, it's got a 68.2% chance that the price will close within this span of price movement. And what you can see is that if the price moves outside of the expected move, we've got ourselves what's called a trend day. And let's also marry that to another term, which is called the opening range. The opening range is the first 30 minutes of price movement and is marked here by this orange rectangle. Notice that we're not using any oscillators or MACDs or moving averages here. All we're using is price levels based on the opening range, and that opening range extended forward in time, which is the yellow rectangle, as well as the upper and lower expected moves for the day. This tells us just about everything that we want to know. Now, last summer, what was working is that we'd have all these range-bound days, day after day after day of range-bound day, where the opening range would set up and the price would not go outside of there. It would just stay within this. And so what we did was we used the iron butterfly day after day after day. Well, at least 3 days a week, because that's all we had at the time. Now we have 5 days a week. However, this is a dangerous trade to play now with the volatility, because we're getting day after day of what's called a trend day. This is a range day if it stays within the opening range. A trend day is where it trends beyond the opening range, and especially if it goes beyond one of the expected move markers. So you can see lately what we've been having is these magnificent trend days that are going well beyond any measure that we expect. Now, how are we setting up these trades and what type of strategy are we using? Here's an example of a day where we had, once again, the confluence of the upper expected move came into play with the opening range, the upper opening range. We had a nice trend day in play here. The price broke above the confluence of the opening range and the upper expected move. And that as the price came down to test that combination from above, we simply took a long entry on a credit spread. And probably the easiest way that we could do something like that is like a put credit spread, where we're selling the at the money option and we're buying the slightly out of the money option. For slightly less, that combination creates a credit and gives us limited risk, limited reward, and a very, very easy trade to manage over time during the rest of the day, which is all that it lasts for. Now, at some point, I should expect to see the price start to calm down, especially if it starts to rally back up again for the next month or two. And then what we'll see is we'll see a reflection of that transition in market character into range-bound days again. And then we can go back and use our iron butterfly strategy once again. But for now, what we're looking for is these massive trend days and looking for a very simple entry point that confirms that it's in a trend day. And that is it for today's Market Minute. I hope that helps, and I'll see you in the next edition of the ReadySetTrade Market Minute. Take care, folks.